So when we discussed about making the financial model, we discussed that first step in making the financial model is to have the past data in the model, past and current data in the model, right? So what is the past data that you want? You want the past data from financial statement. So we discussed in order for you to perform valuation, you need to first have all the data in your model, and then you will forecast future based on past and assumptions. So you will have first past data in your model, and once you have past data, then you will combine it with your expectations or assumptions, and based on those expectations and assumptions you will forecast future, and then you will perform valuation. So for you to forecast future or perform valuation, you need cash flow statement. For cash flow statement, you need balance sheet and income statement, which means the starting point becomes your income statement. That is, first you need to have income statement in your model. So how do you start? First thing is that you find out the income statement of the previous years. So let's say if you are performing it today, so as we discussed that we will be doing a model which will be as at 2016, and you have to recreate the same model as at 2018. So you will have to use all the new figures. So you will, whatever we do in this model will be done by you for 17 and 18. So first step is that you bring in the income statement. So in income statement, you have obviously sales, cost of sales, then gross profit, then operating income, then earning income from other sources, net income from continuing operations, then any adjustments to it, then finally net income, net earnings attributable to Procter and Gamble. So this is just the income statement of Procter and Gamble from the annual report. So how do you find out annual reports? Annual reports are found out through the investor relations website. So every company has their investor relations website. So if you go to investor relations website, you will find out annual reports there. So what you need to do is you need to go get the annual reports and then replicate that data into your file or into your model. So first sheet would be income statement sheet where you will start working. Some key points to note before you go on are that color code your numbers or color code the values. So you should know which, just looking at the sheet, you should know which numbers are hard coded and which numbers are formulas or links. So if you look into this, in this model, I have kept red as the hard coded numbers. So all these numbers which are red are hard coded. Like 2014 is also hard coded. And all the numbers which are black, if it is a value and it is black, then it has some formula into it which is linked to some other cell. So that you know that if you change this, and something that is dependent on something else, you should not be changing this. If you want to make a change in a model, you should change red values or you should change the hard coded values. So your assumptions should be in red, and your past data should be in red, and then your forecast should be in black or any other color which you choose to use, right? So you can easily find out this data from the company's investor relation website. So you will go to investor relation website, pull out the statement. You will pull out the statement for 18, 17 and 16. So ideally it is useful to have past 3 years of data or at least 2 years of data. Do not perform valuation with lesser than 2 years of data. Have either 2 years or more years of data. The larger data you have, the better it would be. But generally 2 years of data or 3 years of data is enough, because we project future based on the current trend and not based on the historical trends which have already ended. So you go to the investor relations website and you pull this data. Secondly, before you start with valuation, another key point to note is that you will be making different sheets in this model. So there will be income statement, balance sheet, cash flow, assumptions, valuations, beta, WACC, all that. So in all the sheets, your format should remain same. So make sure you start all the sheets at the same cell. So your format should remain same. Like I am leaving first column blank in this sheet, so I will leave it blank in all the sheets. Secondly, make sure that this remains constant in every sheet. So this top line should remain constant. So if you have 2014 in D, then 2014 should again appear in D column in balance sheet. So 2000, it shouldn't be like that you have 2014 of income statement in column D and then you have 2014 of balance sheet in column E or column C. So make sure this remains be the same. So your format should remain be exactly the same. So color code and keep the format as exactly same as first sheet, or better would be that you put it all in one sheet and then you link all other sheets with this. Secondly, before you go ahead, make sure that you leave some space in between. Like here, I only have one column, but I would advise that you leave more than one columns. Why? Because if you are making the model for the first time and you do not know company in detail, maybe when you start working on it, some things come up which need to be added. So maybe when you are making assumptions, some new things come up which you did not think of before, and you need to put that detail in your sheet. So maybe you just need to put that detail, some text that you need to put for reference purposes, or maybe some new numbers that you need to put, or maybe some calculations that you need to make or show. So for that purpose, it is useful that you leave 3 to 4 columns as blank and then start after 5th column or 6th column, whatever. Until and unless you have made the model before and for that particular company before, and you know that everything will be in your control. So moving on, with the income statement, it is ideal or it is useful to make a list of key performance indicators, or to make a table of key performance indicators in which you can put in sales growth, gross margin, SG&A percentage, operating margin, tax percentage, net margin, and earnings growth. Why? Because this will help you help you have an idea about the past trend and your future forecast. So your past trend should be uh, any question? Selling, general, and administrative expenses, operational expenses. Right? So if you look into it, it will just be linked to. So like if you look into it, I see sales growth as negative. So that means I need to particularly find out the reason for negative growth and its breakup. Until and unless I do that, I will not be able to forecast future. If I look at gross margin I have improved consistently. It means company has been able to, or this company's expertise to be able to drive savings in the cost, or maybe commodity prices have gone down, or whatever the reason is, despite lower sales, it has been able to improve gross margin. That means company's cost of goods sold are in its control and it is able to manage it. SG&A, no significant change in percentage, which again means that there are no significant changes in the structure, number of people or anything. It is in line with the sales. And as sales grow, maybe company is able to take leverage advantage, and as sales become bigger, maybe this becomes lower compared as a percentage of sales. Operating margin again improved significantly, and it would have improved due to two reasons. What are those two reasons? One of the reasons is improvement in gross margin. If gross margin has improved, then it has to improve. And second reason could be a finance cost, maybe a reduction in finance cost. When we go into detail, we will look into it. Or maybe sorry, finance cost wouldn't appear here. Reason maybe a leverage. That is it, as it has grown in size, maybe some expenses have become lower as a percentage of top line. Or a reason can be other income. So maybe there is some one-time income or some unusual income being reported in 2000 and this current year. And then tax percentage helps you forecast future tax, and then net margin, which is the net earnings divided by sales, and earnings growth. So just it is important so that you have an idea about the past, and so you have an idea about the future as well. And also once you have forecasted the future, then you will need to see the trend, because any company's business plans need to be consistent. So in order to look for that consistency and to ensure that your forecast is correct, you need this key performance indicator. And if anything is changing, you need to have a reason for this. So there can be any change in your forecast. Maybe you go from 49 to 55, or maybe you go from 49 to 35. But whatever the case is, you need to have a reason for your forecast, that what is the reason for that particular change. So this is the first sheet